Okay, we will get started now. Good evening to all of you. Welcome to the seminar on strategic cost management to drive business performance in the new normal. Today, we are very happy to have with us our distinguished keynote speaker, Gary Hawkins. Also, we have with us Mr. A.N. Raman, who will be the moderator for the session. He is our own CMA Advisory Council member, past president of SAFA. And we have our Vice President, Mr. Hennayaka Bandara, our council members. We also have our distinguished panelists, Dr. Nuwan Gunratna, a senior lecturer at the University of Sri Jayawardenapura, currently in Australia, where he had been on study leave, and we wish to welcome him. Then also we have Mr. Mahendra Jayasekara, who is the chairman of the Cost and Management Accounting Standards Board. Then we also have our distinguished invitee from India, Mr. Tiruvengadam Parthasarthi, who is a former consultant to the and director at Deloitte, and our other friends from the CMA and our distinguished participants who are present here. So as I said earlier, we are really in a different atmosphere. We are maybe fighting with the COVID, and as a result, our theme is on strategic cost management to drive business performance in the new normal. Now, cost and management accounting has really become much more important and is playing a key role because of the current situation that we are in. We are looking at revenue, we are looking at cost, we are looking at cash flows. These are some of the very important areas for all our management accountants and business professionals. So today we are very fortunate that we have a very eminent speaker, Gary Hawkins, an internationally recognized experts, speaker and author in advanced cost management and performance improvement systems. He is the founder of analytics-based performance management and advisory firm located in North Carolina, USA. So I must also thank Dr. Nuwan, who's here with us today, because he really put me in touch with Gary and was saying that we should get him for our conference, our seminar that we are having today. So I contacted him and he readily agreed to come. But I also know that Gary had a long standing relationship with Mr. Raman, Mr. A.N. Raman, who's here, and I know that he's been speaking about you from a long time ago. And then when this came, I thought that this would be an ideal forum, not only for Gary to be there, that we have Mr. Raman also, who will be with us. And today's participants includes quite a lot of people, a lot of our members from, not only our members, but also those from the SAFA region. I can see a lot of our friends and colleagues from India who are here, and some of our old friends like Dr. Jagannathan, who's here, and some of the others from Bangalore and other places. And also one of our very good friends from Nepal, past president of SAFA, Mr. Komal Chitraka. Welcome, Komal. I'm very, very pleased to see you. And maybe later I will try to get you on to the speakers panel to see you. So with those introductory remarks, I would like Mr. Raman, who is a close associate of Gary, I would I will invite Mr. Raman, who is an advisory council member of the CMA. So we have a very close link with him. He's also involved in helping our Cost and Management Accounting Standards Board and all our conferences in our integrated reporting. So many areas we've had a very long relationship, and is really someone who's been very close to us. And our profession, we are today celebrating our 20th anniversary. We are maybe in Sri Lanka, we really have to build the cost and management accounting profession. Although the local body is 20 years, of course, we've had a foreign body operating here, but the government has recognized the importance of cost and management accounting. So that's why they set it up by an act of parliament. And now we are also members of the International Federation of Accountants, the South Asian Federation of Accountants, which are our members are very close. So may I now invite Mr. Raman to introduce our eminent speaker, scholar, Mr. Gary Kokins. Over to you, Mr. Raman.
Thank you, Professor Lakshman and President of our institute. It's a great evening for me because I have the pleasant task of introducing my very good friend Gary. For more than 2 decades, we are in touch and we have got very good professional interaction. It has been really a fantastic journey with my good friend Gary Kokins. But some of the points in which I would like to emphasize with my familiarity with Gary is like this. There are very few people who have come from the engineering profession to this cost and management accounting and who have really made a very distinguishing mark. My remembrance very clearly goes only to 2 names. The first one is Dr. Robert Kaplan, whom Gary also knows very well and closely. He's basically an electrical engineer. He came into the management accounting profession and really he made a mark for himself. The second one is Gary himself. I'm sure that many of you may not know that Gary is, if I guess, an industrial engineer. He can confirm or modify that. He is basically an engineer, but he has walked into the cost and management accounting profession. But certainly it is not a loss for the industrial engineering profession, but certainly it is a gain for the cost and management accounting profession. And that is Gary for us. He is a second classic engineer. And of course, the third one we have on this session itself, Thiruvengadam, is also belonging to that particular category. But these 2 gentlemen, Dr. Robert Kaplan and Mr. Gary Kokins, they have really made a mark for themselves and globally. And the way they have distinguished themselves in the form of various writings and advocacy of cost and management accounting, it has been just fantastic. But within these 2, the speciality of Gary is that he strikes a personal rapport with anyone whom he comes into contact with, or alternatively, anyone who comes into contact with Gary, they also get a very good personal rapport connected with him. Like, for example, if you go to any part of the country, it can be India or Pakistan, or it can be Bangladesh, anyone like me, if you refer the name Gary, he says, yeah, last week also I received a mail from him. That is the way in which Gary interacts with everyone, and he makes us feel that every one of us are closely connected to him. That is a fantastic way in which Gary has been interacting with all his network of, must be a huge network of friends globally. And I am really proud that I am one among them. That is the way in which Gary is so good personally to all of us. Professionally, I would just give a very simple example, which I thought a fantastic visualization of what Gary can give us when he wrote his initial books on a primer on activity-based costing. When in those days, good literature was not available, the 2 books which he had written, they were really fantastic. So the one visualization which he gave me very clearly, and by reading that book, and I could really understand what the man is, I am going to narrate that. Many of you can easily understand what he is really indicating in that. Imagine a 20-floor skyscraper you want to get in. Not only you, let's say there are around 100 people waiting at the bottom, that is a 0 floor, and all the 100 want to get up into some floor or other. So all the 100 get into the, let's say, 10 lifts or 10 elevators you have. Let's say there are 10 elevators. All the 100 or 200, any number, you will find they get into that. But ultimately, when all the 10 elevators reach the top floor, all of them have reached their destination. This is exactly what Gary gives us an illustration of the target achieved by the activity-based costing allocation process. Exactly, it takes the resources to the person, to the pace, to the point where it has been really consumed out of the process where it really belongs to. So the elevators completely exhaust the complete passenger burden which is there on the bottom, and it reaches it to the current destination. This elevator example, Gary gives as an introduction to the way he brings in the role of activity-based costing, which he introduced through his books 25 or 30 years back. Am I correct, Gary?
Yes, you are.
So this is that fantastic illustration which he gives. And I would never forget that. That is the way in which I have been very aptly introduced to this subject by activity-based costing. And that is Gary for us, the visualization and the man, the brain behind that sort of giving a wired circuit of what really happens in activity-based costing. Fantastic. And gradually and eventually, he has also become an expert in performance management, the rightful place where all these techniques lie. So today we are going to listen to Gary about how all these things get slotted in a typical strategic cost management environment, and that too in the new normal. Very tactfully, Professor has placed this theme in a new normal situation where the entire business models, whichever be the country you are seeing, is witnessing the digitization completely turning the business models upside down. You need to contact the customers, sell the products, get the feel of the customer service, everything, even including manufacturing, has to be done through accepting a significant intervention of digitization. And that is making the business models completely sophisticated. And it also has a very important advantage for the protagonist of activity-based costing or any other domain of cost and management accounting. So we have got a new challenge, a new challenging environment of reinventing or rewiring the strategies in a new normal situation where digitization has uprooted the business models or transformed the business models into a new state. So with this background, we are very eagerly here, waiting here to listen to Gary as to how he visualizes the cost and management accounting techniques being placed in the context of a strategic cost management in the new normal. Thanks, Gary, my good friend. We are all ears to listen to you, and our antenna is up.
Well, it's a privilege to be here. Let's get through the technical. Let's see if I can get the share screen. Did you, I hope, have...
Yeah, that's on. Gary, I just want to make one announcement. That is, those who want that if they want to ask any questions, please use the chat or the Q&A. So please use that. And of course, our panelists who are present will pose questions to Gary after his speech, which will be moderated by Mr. Raman.
Okay, well, put your seatbelts on. I'm going to cover a lot of material. It's a privilege to present to you. Unfortunately, I've never been to Sri Lanka, but I've been to India, boy, 5 or 6 times, all the cities, Chennai, Hyderabad, Delhi, Mumbai, Bangalore. It's always enjoyable to visit your country. So I hope you're not in just 30-minute chairs, because this is going to be, about an hour? I will go about for an hour and 15 minutes, and then we'll have the panel discussion. So let me share a little bit more about myself. And thank you, Anne, for your nice presentation, introduction of me. I was blushing, and instantly you introduced me as an expert. I don't believe I am an expert, but I don't think there's experts in any fields anymore. There's just way too much complexity. Even Professor Kaplan is not an expert. We always keep learning. I did get my industrial engineering degree from Cornell in 1971. And then I went on to Kellogg School of Management to get my MBA. If you're doing the math, I am 71 years old, but I feel like I'm 41. I still feel young. My career was really in, I think, 3/3. My first decade was in industry, a large conglomerate company in the United States, FMC Corporation. Then 15 years of consulting with Deloitte, KPMG, and then Electronic Data Systems, which is now part of Hewlett Packard. And then up to 8 years ago, I was 16 years with SAS. Many may not recognize who SAS is, but SAS is the world's largest privately owned software vendor with analytics as a specialty, and there are operations in India. Why are the books there? I think careers have a lot more to do with luck and circumstances than being smart and competent. And I had two lucky breaks. My first one, when I was 27 years old, I wound up being promoted to a financial controller in Milwaukee, Wisconsin at a division. And I did that for 3 years. And then I had the opportunity to become the operations plant manager on the factory floor. And I used the phrase, I then had to eat the accounting data that I had been serving as the accountant upstairs. And I found much of that information to be at best useless and at worst dysfunctional and misleading. And that was a real wake-up call to me about the difference between external financial reporting for statutory and regulatory reporting and internal management accounting information. But my larger big break was in 1988, KPMG struck an exclusive contract with Professor Robert S. Kaplan of the Harvard Business School to train KPMG consultants. I was with Deloitte at the time. I got recruited because Dr. Kaplan said, I want to train people who have like engineering backgrounds. And I like to say that I'm an engineer masquerading as an accountant. And for 5 years, I did nothing but implement ABC. I wrote a book and that led to more books. So that's a little bit of the background on me. So let's go. Who will benefit from this presentation? Managers and executives who must now recover their operations as the pandemic eventually subsides. Managers who have struggled at promoting financial planning and analysis, corporate performance management, and integrating business analytics into their decision support systems. And managers who intend to champion any or all of these CPM and business analytic improvement techniques, including internal management accounting, they need a compelling call to action. And the reason I have champion in quotation marks is because it's just been my observation that although it's nice to have senior executives advocate new methods and innovations, often they are preoccupied with firefighting and short-term priorities. It's typically managers 1, 2, 3 levels down in the organization chart who basically have kind of passion or fire in the belly and ask themselves, how long do I want my organization to perpetuate using stale and old and arcane methods? And they're the ones that will do a pilot or a proof of concept to demonstrate to their fellow line managers and the executives above them, these are the more progressive methods that we should use. So if you are down in the organization chart, I enjoy presenting to you. So I've got quite a long agenda here. I'm going to start off by talking about the bigger umbrella. What's this corporate performance management? I briefly want to show you a taxonomy. Then I want to talk about strategic management accounting. That's pretty much for just, if you will, project, well, initially with just products and service lines. Then we'll go below the product gross profit margin line about customer profitability. Then we're going to shift to the predictive view, budgeting and rolling financial forecasts. I want to show you an assessment, stages of maturity that you can actually evaluate what stage of performance of quality of your management accounting systems. Basically, I'll show a big picture how it all fits together. And then I'm very frustrated with the slow adoption rate of these methods. That'll be how I finalize it. So let's go. There is confusion and lack of consensus about corporate performance management. Is it human resources? Actually, if you Google just the term performance management, it will show up as, the human resources and personnel function, employee appraisals. The problem is we didn't put the corporate adjective in front of it. It's much broader. Is it about scorecards, dashboards, key performance indicators and measures, the balanced scorecard? Yes, but that's a subset. Is it about aligning those resources with the strategy? Same thing, strategy maps, balanced scorecard. Yes, but it's a subset. Is it about process productivity and quality improvement? Yes, but that's business process management. That's more of the world of lean management and Six Sigma. It's part of the umbrella. Or is it all the above and even more? And it is. And the good news is this: corporate performance management are not these new methods that people have to learn, but they are existing methods that most people are already familiar with. They've read about it. They may not have implemented them in their organization, but they are aware of them. The problem is when organizations do implement them, they implement them in isolation of each other. So you have budgeting people in one part of the building, you've got profit pricing people in another part of the building, you've got risk management people, other part of the building, process improvement, other part of the building. You get a lot more power and synergy when you integrate these like gears in a machine, and even more power when you embed analytics into them of all flavors. So that's basically the definition. Now, what's caused interest in corporate performance management? I mentioned these methods have been around for decades, some even before computers. I'm going to take 3 or 4 minutes and go through these 8 methods, and then we'll zero in on the ones that apply to management accounting. The first one is executive frustration with strategy failure. Most executives are pretty good at formulating the strategy for their organization, or they'll bring in a high-end consulting firm to help them. Their big frustration is failure to successfully implement the strategy. Next problem, increased accountability. Today, there is no place to hide. You will be measured. You will be monitored. It doesn't necessarily mean that your job is at risk, but it could adversely affect your job promotions or salary increases. 3, more rapid decision-making. Unlike several years ago when you could test and learn and have meetings in conference rooms with your supervisors, today you're on the phone, go or no go, yes or no. People need to make decisions in near real time. They almost wish that an executive was sitting next to them on the phone call and say, what decision should I make that fits your strategy? 4, mistrust of the managerial accounting system for transparency and accuracy. When we get to that, that is the discussion that includes activity-based costing. The reality is most line managers do not trust the management accounting information. They know about those butter spreading cost allocations, which we'll talk about. Number 5, poor customer value management. We must understand that customers are the source of value creation for shareholders and owners, which means we need to connect the actions we take to basically improve profitability by customers all the way back. 6, contentious budgeting, poor resource capacity planning. This may surprise some of you, but I think the annual budgeting process is so broken and is such a disaster. The best solution is stop budgeting. So did I catch your attention? Probably. But if we want to stop budgeting, we need to ask the question, what was the purpose of a budget in the first place? And what can we basically replace it with? And we'll talk about that there. Number 7, dysfunctional supply chain management. This may not apply to all of you, those of you that are in the business to consumer, but those that are in the business to business supply chain, here's the issue. Most customers treat their suppliers as the enemy. They basically pound on them. They try to negotiate lower prices of their supplier. If they put the supplier out of business, so what? We can always get another supplier. That's got to stop. It needs to be a marriage. Supply chains are competing against other supply chains for share of wallet or share of purse. They basically need to work together. And finally, 8, unfulfilled return on investment promises from large IT systems such as enterprise resource planning systems, ERP, or customer relationship management. And if you were to ask a chief information technology officer, in other words, the IT director, how confident are you? This is 3 years after they've gone through the difficulty of implementing their ERP system. How confident are you that the return on investment meets or exceeds what the software salesman sold you on 3 years ago? Many of them will be hard pressed. They'll say, gee, we just spent 3 years implementing this thing and I'm not sure we've got the return. That does not mean you should not implement the ERP or CRM system. You have to remain competitive. But the problem is those ERP systems produce a lot of data, but not necessarily information. What corporate performance management, including management accounting, it converts the data into information like seeds out of the ground. And so the ROI actually comes from the CPM methods. So you'll be able to get a sense of the slides. I'll be sending them to your managers. This is that definition. CPM is the integration, multiple methods with each embedded with business analytics. It's like segmentation, especially predictive analytics, to achieve the strategy and make better decisions. So of the 8, the rest of my presentation is going to be on these 3 in the middle: product profitability, customer profitability, budgeting, and rolling financial forecasts. And some of the material here comes from actually a two-part article that I wrote for the Institute of Management Accountants in the United States for their magazine, Strategic Finance. And just a little background, when I did retire from SAS, the CEO, Jeff Thompson of the IMA, and the IMA is 130 plus thousand members in 140 countries. He said, Gary, not going to let you sit in a rocking chair down there in Raleigh, North Carolina. Although I am a Chicago native, go Cubs, go Bears, if you're familiar with sports teams in the US. And he said, I want you to be the part-time executive in residence. I did it for 3 years. And I said, I will write articles for the magazine. And this is one of them. So let's talk about the taxonomy. This is like in biology, you know, plant kingdoms, animal kingdoms. That's what a taxonomy. The big taxonomy of the big world accounting has 3 kingdoms: tax accounting, financial accounting, and then managerial accounting. Just to clarify, you know, all the accounting information starts with source transactions, typically from payroll or purchasing systems and invoicing systems. We always calculate costs from expenses. Expenses and costs are not the same thing. Expenses is when an organization exchanges money with third parties or pays employees. You know, it's like writing a check. Currency exits the treasury. All costs are calculated. A product cost, a channel cost, a customer cost. So we calculate the cost. But for the external reporting, we basically follow rules, generally accepted accounting principles. You know, this is for the regulatory agencies or statutory, things like inventory valuation. But for management accounting, we don't have to follow those rules. It's modeling. So we start with all the cost reporting and analysis, looking back in time. Then when we go to the predictive view, it's about decision support and cost planning. Now, sometimes I offend and upset CPAs, chartered accountants, because if you look at the lower part of this diagram, and I created this diagram for the International Federation of Accountants. If you're not familiar with IFAC, they're in New York City. They're like the United Nations of accounting institutes, I think 180 of them. And I have the value spectrum. It's low value at the left. Then we go to the right, modest value add, high value add. The point is the value of accounting information increases as you move from external reporting to internal management accounting and then all the way to the predictive view, because all decisions are made in the future. More of this information, incidentally, is in my website. So notice at the bottom, GaryKokens.com. If you go there, the horizontal tabs, they are free downloads, including this paper. So let's talk about the profitability. I said number 4, mistrust of the managerial accounting system and its flawed cost allocations and misleading cost reporting of outputs, products, standard service lines, channels, customers, and outcomes. And incidentally, the reason I say products and standard service lines is because many organizations don't make products. It's interesting. In the United States, get ready for this, only 2 out of 10 jobs make products. The other 8 are services like banks, insurance companies, you know, travel agencies making reservations. They're not physical products. Only 18% of the United States GDP comes from manufacturing. But my point is management accounting is universal, so it can apply to any organization, including government organizations. Now, here's part of the problem with accountants. This is meant to be funny. The vertical axis is as you increase your skills, and the lower horizontal axis is your stage of life. So if you know you're in kindergarten, or you know you learn how to do numbers and then math, you know, addition, subtraction, then geometry, algebra, trigonometry. Boy, now we're into, you know, advanced calculus. You're in the university, and then where are you today? Spreadsheets. We got to get away from spreadsheets. There's more powerful tools. So quickly, let's basically understand that when we are calculating costs, there is a spectrum. The highest form to get accuracy, if you look to the left, is going to be project accounting or job order accounting. But that only applies when you have unique outputs. There's no repetitiveness. Then we move to standard cost accounting. That's when we do have repetitiveness. And of course, manufacturers use labor reporting, routings, and bill of material. ABC is really like a poor person's standard costing system. It's not as difficult to do as standard costing, but it replicates it. The real message on this slide is do not do allocations. And we'll talk about that in a few minutes at the right. So that brings the issue of the topic of activity-based costing. And I find this is the easiest way to explain ABC. Imagine you go to a restaurant with 3 other friends. You order a little salad, and the other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. Well, that's how products and standard service lines also feel in a general ledger and standard cost accounting system when the accounting department takes this large amount of overhead, which is more properly called indirect expense, and they spread it like butter across bread using cost allocation factors like direct labor money, direct labor hours, number of units produced, sales amount, head count, full-time equivalents. None of those cost allocation factors reflect the unique consumption that the products and service lines consumed are the end-to-end business processes and the work activities that belong to them. So if you do what ABC does, is it will decompose the overhead into multiple cost pools and trace them to products and service lines using a cause and effect relationship. And after you've done that, if you compare that to the traditional butter spreading approach, you will discover some of the products were overcosted and the others must be undercosted because it's a zero-sum error game. And that means the accountants are providing flawed and misleading information to their line managers, and they're making decisions with this bad data. So the simple definition of ABC is as if the waiter or waitress in the restaurant brings you 4 individual checks. You only pay for what you consume. And this led to my writing of one of the books after I was trained by Professor Kaplan. And I do not suggest you buy the book. I'm not promoting my books. If you go to some of the book websites, chapter 1 is usually a free download. That's probably all you need. So let's talk about why the interest in ABC over the last maybe 60, 70 years. It has to do with this diagram. It shows the 3 universal components of any organization's expense and cost structure. The direct and recurring labor. I like to use the word recurring because, you know, insurance companies, banks, they don't think like direct labor, oh, that's manufacturing, but it's the repeatable work. Then the direct material, and then the overhead, properly called indirect expense. When you ask people, why do you think the overhead is displacing the direct, they will say, well, machinery, computers, automation, you know, we're kind of automating out the frontline workers. That is secondary. The primary explanation for this displacement and shift is over the many years, all organizations have had an increased proliferation of different types of products, different types of services. Manufacturers, more colors, more sizes, more ranges. Banks have more different types of depository accounts and so forth. The point is this: when you increase the diversity and variation of the outputs, it just produces complexity. And complexity causes the need for more and more indirect expenses. So 50, 60 years ago, when you had just a single type of product, all right, you could peanut butter spread the indirect because most of the accuracy came from the direct costs. But that is not the case today. The indirect is very substantial. So we need to trace and assign it. Now, the problem actually begins with this traditional responsibility cost center statement. Every manager on the planet Earth recognizes this statement. But when they receive it, the managers ask themselves, how much insight and understanding do I get about the cost that I can influence and control, and where does it go? And their answer is not much. I like to say when managers get this kind of report, they are either happy or sad, but they are rarely any smarter. And it doesn't mean the report's a bad report. The report is an excellent report. It's just that the data in it is structurally deficient, meaning it's not structured in a way that can answer the question. So what activity-based costing does is it changes the structure. It shifts it from those salary, equipment, the ledger accounts and the general ledger to the middle box. Key scan claims, analyze claims. These are the work activities that the department does. And then it reassigns the same amount of money, this is US dollars, 914,500, into the product, services, and customers, just like the waiter or waitress in the restaurant. So effectively what you're doing is you're converting the expenses to the left all the way to the outputs, like the elevator that An analogy made. Now, when you think about where do expenses begin, most people think they start on the left side. They actually start on the right side. The products and services place demands on the middle box, the workload, and then the workload draws on the spending, and the costs measure the effect in the opposite direction. So demands on work flow right to left, costs measure it left to right. It's a principle. Rules are many, principles are few. And just principles like speed of light or gravity. Problem is most accountants violate that principle when they butter spread cost allocations. Now, it isn't quite as simple to basically just, we take our ledger resources, we convert them to work activities and assign them to cost objects, because it really needs to be a multiple stage cost assignment network. I've rotated that previous diagram 90 degrees. Because you have support departments that support other support departments that ultimately support the frontline departments. So it must be a multiple stage assignment. Now the next slide is going to look complicated, but I want to train you. This is a pretty good view of any organization's costing structure. You start at the top with those resource expenses. We then convert them into the work activities in the middle. And then they eventually pile up at the bottom into the products, the service lines, the customers, is something we call business sustaining. Now you need to adjust your thinking. This is not a flow chart end to end with swim lanes. This is a reassignment network. So if an organization, let's say, spent $2 million US in January, it will be the exact same $2 million of work activities, and they will eventually pile up at the very bottom into the customers and the business sustaining, and it will reconcile exactly. All of those arrows from top to bottom, think of those as thin straws or wide pipes, where the diameter is reflecting the amount of money flowing through. That's why it reconciles exactly. The bottom module is, think of that like the predator food chain. Large mammals eat small mammals eat plants. Customers are the ultimate destination of where spending goes. And so you notice they will actually be consuming the products. We would use the sales register volume. Notice that there are some of the activities that are not going to the products, going directly to the customers, and we'll get to that. We call that the cost to serve. There is a special category called business sustaining, because there will be some expenses that have nothing to do with making products or serving customers. Like the legal department, or even when the accounting department is closing the books. It's not traceable. So we create business sustaining cost objects like senior management. They want to receive the reports. You still need to recover that spending. Typically, it's 10 to 15% of an organization's monthly spending. You still need to recover it with price. It's just not traceable, okay? Now, direct cost, not broken. You may have data integrity issues with your direct costing. That's a different issue. So what's the consequence when you do ABC? It's overcosting and undercosting. So if you look at the horizontal line in this rectangle, that would be your traditional butter spreading, standard costing, general ledger stuff. But when we do ABC, that's the sloping line to the left. That's going to be where the simple products are basically overcosted. They're subsidizing the other ones. This is like you in the restaurant ordering the salad. You're on the left side. To the right side, that's where we've been undercosting. That's the three other people that ordered the expensive item on the menu. So what ABC does is it corrects for the inaccuracy of the traditional costing. Now, this is much more important. What does one see after you've calculated ABC? And what you're looking at is actual data from a real company. The vertical axis is the net revenues minus the properly calculated and traced ABC cost. The horizontal axis is the cumulative buildup of the profit, but it is rank ordered from the most profitable product to the next most profitable product, and so on and so forth. The very last data point, the $2 million, it will exactly reconcile with the profit and loss statement. So in this particular example, this company had quarterly 30 million in sales, 28 in expenses to net out at 2, and the last data point in the graph is 2. When companies receive this report, the executives go into shock. They cannot believe it. Because in this particular example, it said, look, you made roughly $8 million of unrealized profit on 3/4 of your most profitable products. You lost 6 million on the remainder to net out at 2. And before ABC, their belief system, it was just this blue line. And that's because all that butter spreading allocations was crushing and suppressing the true cost. And what ABC, multi-stage cost assignment network, that piping detected the diversity and variation, and it reflects it in the top line. So the top line is the truth. The blue line is flawed and misleading. Now, some of you may be asking, well, what do you do about those unprofitable products on the right side? Do we drop them and abandon them? No, that could be a mistake, because some companies deliberately have what are called loss leaders. They price below the true cost, but those loss leaders are associated with more profitable parts to the left. And so it's a combination. Also, management accounting does a terrible job with life cycle costing. Most accounting is all period-based, January, February, March. So if we have a new product that's just been released, it will have maybe not much sales volume, and it's a shakeout period with extra work. It will appear to be unprofitable on the right side. But each time we refresh the model, it will migrate to the left side and eventually be profitable. But the point is this: at least the top line is fact-based data. At least the top line is fact-based data. And remember this: in the absence of facts, anybody's opinion is a good one. In the absence of facts, anybody's opinion is a good one. But usually the biggest opinion wins, which is the opinion of the boss or the boss of the boss. So to the degree that those higher level executives are making decisions on gut feel or intuition or flawed and misleading information like the blue line, an organization is at risk. Now, there's more that meets your eye in that diagram. If you looked at just one of those data points on the right, the unprofitable ones, what's really happening is each product is reaching up into the work activities and asking, how much of each of you did I uniquely consume last period? And it piles them up like pancakes, where the stack of the pancake is basically reflects the thickness, and though that is determined by the quantity of the driver times the unit level driver cost consumption rate. So basically, even the operations people, if they can reduce the frequency or intensity or quantity of the driver, the stack will go down and they will then be reducing their costs. Now, this is a cartoon that's part of my frustration, which I'll get to at the very end of this presentation. You've got this signboard. It's the answers. The sign to the left says simple but wrong. The sign to the right says complex but correct. Look how many people are taking the left path, and they're falling off the cliff. They're becoming bankrupt. The CFOs need to start taking the right path. It is a little more difficult to do activity-based costing, but I'll describe to you it's not that difficult. Don't continue to take the left path and give your managers flawed and misleading information. So let's start talking about how we basically move from product costing to product cost to customer costing, the shift from being product-centric to customer-centric. The value of any company is the value from its customers. The only value a company will ever create is the value that comes from its customers, the current customers and the new customers acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make the customers more profitable, serve them more efficiently, and acquire relatively more profitable customers like the ones you have now. But we have some problems. Most CFO and accountants are not calculating customer profitability. They're stopping partway down. They're stopping at the gross profit margin line. You've got to go below the gross profit margin line to include expenses from distribution channels, selling, marketing, customer service, okay? Products and standard service lines are not the only thing which accountants should compute costs for. What about all the costs that have nothing to do with making products and delivering the standard service lines, the ones I just mentioned? The problem with traditional accounting's product gross profit margin reporting is you don't see the bottom half of the picture. Bottom half being below the product gross profit margin line. And visually, if this is the entire rectangle is the expenses for an organization from, like, say, last month, the shaded part is just the product and standard service lines. And it'd be nice if the indirect expense was assigned using ABC. But look at the white boxes: distribution, sales, marketing, general. That is far more important than the shaded spot. And here's why. I call it the perfect storm. There are 4 major reasons why below the line is important. Number 1, customer retention. It is relatively much more expensive to acquire a new customer than to retain an existing one. Well, that's a no-brainer. That's because existing customers, you already have them. And when you understand decision theory only should be impacted for future impacts. So those are sunk costs. You don't need to worry about existing. Next, sources of competitive advantage. As products and standard service lines become commodity-like, then the shift is towards service differentiation. As I mentioned earlier, customers are the source of value creation for owners. But as the product differentiation, more colors, more sizes, more ranges, all of that, your competitors match you, you've got to go to service differentiation. Number 3, customer relationship management, one-to-one marketing. Pepper and Rogers have hailed technology as the enabler to identify customer segments and tailor marketing officers. Okay, Pepper and Rogers, Don Pepper and Martha Rogers, these are gurus in the marketing world. And what they're really saying is work backwards, knowing the unique preferences and characteristics of different types of customers, and then tailor the offers, the deals, the price discounts to them. And then finally, the power shift. The internet is shifting power irreversibly from sellers to buyers. This is a one-time event happening in our lifetime, the internet. And I just don't mean you and your household spouse ordering products through the internet. Today, purchasing agents in a company with a click of a mouse can see 10 to 15 suppliers and all of the expenses and pricing about them. So if you take these 4 forces, put them together, it says customer is really important. But here's another problem: angel customers and demon customers. What do I mean? Every company has high maintenance and low maintenance customers. Examples of high maintenance customers: always changing delivery schedules, always demanding special, not standard product, always returning goods, always calling help desk. Low maintenance customers, you love them. Only buy standard, never shift schedule, never call help desk, never return goods. If those 2 types of customers bought the same volume, same mix at the same price from you, they are not equally profitable because the high maintenance customers are causing you a lot of work. So what this really means is sales volume is not basically synonymous or equivalent to the profit from a customer. So you can calculate customer profitability, and I won't go through this diagram, but it's basically the multi-stage cost assignment network decomposed. And if you are interested in understanding this diagram, if you do go to my website or to the IMA, just look for a statement of management accounting from the Institute of Management Accountants called implementing ABC. It's 30 pages. It will show you the diagram. But here's the point. As we basically trace those costs into the final cost objects, we're stripping away profit, and that gives us this, a basically layered P&L, profit and loss statement by each customer. And the margins are layered like an onion skin. And in this fictitious example, look to the right, you can see that this particular customer had a 30% composite gross profit margin because they bought multiple products at different margin rates. But between the 30 and the 8, 22 more points of profitability are lost, nothing to do with making the standard product or service, all to do with distribution, selling, marketing. And if you were to calculate these two broad swaths for every customer, you can put them onto a grid that looks like this. Each customer is a circle intersection in this grid. The vertical axis is the product mix gross profit margin, in other words, the above the line, and the horizontal axis is below the line. So we've got those angels on the left, we love them, low maintenance, and we got those devil high maintenance customers to the right. And now things are perfectly obvious. The most unprofitable customers will be in the bottom right because they're buying low margin profit mix from you and they are difficult to serve. The most profitable ones are in the upper left because they're buying high profit margin mix from you and they're easy to serve. And now the name of the game is move the dots from the bottom right to the upper left. And that would be a presentation from someone else from marketing, not me. But if they did present, some of the actions they would take would be, well, let's do fee-based. When they cause extra work, we'll charge them an extra fee, or cross-selling or upselling to move them up there. At this extreme, we could fire the customers at the bottom right, terminate the relationship altogether and say, go to one of our competitors and have them lose money. But that's tricky because if we fire the customer, the revenue goes away, but not necessarily the cost. So we would free up unused capacity, and then we need to basically figure what to do with that unused capacity. We'll talk about that a little bit later. This is why you need to think like an engineer, not like an accountant. The same data points I have on this diagram. The circles are now squares. The vertical axis is the profitability of the customer. The horizontal axis is the sales volume. You'll notice that the square to the farthest right, that's the largest sales customer. But above it are few customers, less sales, more profitable. But below, we have some sizable sales customers that are unprofitable. Again, the point, sales volume is not equivalent to profitability. Some of you may be asking yourself, Gary is making sense. We do not do activity-based costing at our company. We probably should, but it would be difficult. It would be a mudslide of data. It would take 6 to 12 months to implement it. Every employee would have to fill out a timesheet, and they hate filling out timesheets. There would be 3,000 activities in it. The IT department would have to extract data from the ERP systems to put it in, on and on. Those are all misconceptions. There's a technique called rapid prototyping with iterative remodeling that you can implement ABC in 3 to 4 weeks, not 6 months. And the way the technique works, and I can basically train consultants, and you can ask me, if you want to email me later, I'll tell you how to do this. You start with model 0. It's a 2-day workshop. 5 or 6 cross-functional people in a room, quickly build a high-level ABC model. Its purpose is not to provide usable data. Its purpose is so that in the afternoon of the second day, you bring in the line managers and executives into the room. The 5 or 6 people show the model, the cost assignment network to them. The light bulbs go on with everybody. Oh, that's how we can assign and trace costs. That's how we could validate our pricing. That's how we could do benchmarking with apples and apples and so forth. You're getting buy-in. You're accelerating their learning so they get it. They start thinking about what they would do with the better information once they have it. Then you do 2 or 3 iterations. Within a few weeks, You've got a permanent, repeatable production model, good enough. Make your mistakes early and often, not later when the system is too hard to change. The reason rapid prototyping works has to do with this diagram. The vertical axis is the accuracy of what you want to know. Let's just say you just want to know your product costs. The horizontal axis is the level of administrative effort to collect the data, validate the data, calculate the data, report the data. You will always get an asymptotic curve, meaning the accuracy will go up relatively quickly and then level off, diminishing returns on extra accuracy for the extra level of effort of work. So look at the black line I just showed you. Look how the slope goes up really fast. What do you think determines that slope? Most accountants don't know it. They think it's timesheets. No, it's the multi-stage cost assignment network. It was that piping diagram I showed you 10 or 15 slides earlier. If you basically design the relationships of where activities go, and maybe just using percentage estimates, 30, 30, 40, 10, 10, 80, everything normalizes to 100%. So you don't have to extract the data. Use the brains from those 5 or 6 employees or more to do it. Is the higher climb worth the better view? Stop at 95%. That's good enough. Remember, this is management accounting, not external financial reporting. External financial reporting, if you get those numbers wrong, you go to jail. You get the management accounting numbers wrong, you don't go to jail. So, just get it good enough to start making better decisions. There needs to be a shift in the CFO's emphasis. The CFO must now help sales and marketing to better target customers. The spending budget for sales and marketing is critical, but it should be treated as a preciously scarce resource to be aimed at generating the highest long-term profits. This means answering questions like, which type of customer is more attractive to newly acquire, to retain, to grow, or to win back, and which types of customers are not attractive for those. And then once you know which ones are attractive, how much should we optimally spend attracting, retaining, growing, or recovering each customer microsegment? And the reason I have optimally in italics in that sentence is it is an optimization problem. Here is why. Remember the book? I didn't mention the subtitle of the book, Discover Which Type of Customer is Which and Turbocharge Your Stock Price. We want to connect customers all the way to shareholders. Well, there are 2 ways you can destroy shareholder wealth. The first way is by overspending unnecessarily on loyal customers for what is needed to retain them. So you're doing all this extra whining and dining. I'm exaggerating a little bit. They were still only going to buy the same volume and mix. So you spent too much money. It wasn't needed. But you can also destroy shareholder wealth by underspending on marginally loyal customers, ignoring them, not treating them very well, and risk their defection to a competitor. So therefore, what is the optimum spending level for differentiated services, different pricing, coupons, discounts, and like, to different microsegments of customers? And I use that word microsegments because marketing people they don't look at customers as, old, young, male, female, 4 squares. They may have 30, 40, 50 ways of segmenting them. We've got to help support sales and marketing. Very quickly, if you've heard of the term lean, it's okay to do lean accounting. It can coexist with other methods. Any company can have 2 or more coexisting costing systems, different types of costs for different types of purposes. And if you want to read more about this, in this link is an article I wrote called Lean Accounting and Activity-Based Costing, a Choice or Blend? The answer is it's a blend. Real quickly, ABC is a reassignment network. So notice all the little X's in the middle are the activities. We trace and assign them to the products, orders, and customers. That gives us that profit and loss statement by each customer. You can also sequence, stringing like pearls in a necklace, the same activities in an ABC model to get a process flow chart. And here is what's called a value stream map that's popular with the lean management accountants. Now the stacks are the magnitude of the activities, but now they're in a process flow, not an assignment view. And then what they like to do is assign them value added, non-value added. Again, the point is this: it's okay to have 2 or more cost accounting systems, different types of costs for different purposes for different users. Okay, I mentioned that the budget is a problem. The budget is typically a fiscal exercise done by the accountants that is disconnected from the executive team strategy. And it's typically not based on future driver volumes. It's volume insensitive. So here are some of the problems with the budget. Imagine you were having to put X's in these boxes. How much of these apply to your company? Our budget is invasive and time-consuming with few benefits. It takes 14 months from start to end. Well, maybe 6 or 3 months you start preparing it. Our budget requires 2 or more executive tweaks at the end. After you produce it, give it to the executives. They don't like the numbers, not enough profit. Go back and change some numbers. Our budget is obsolete in 2 months due to events and reorganization. It's already obsolete just after you published it. It starves the departments with the truly valid needs. Something is going to be happening in this coming year. The department's going to have a bigger workload, but we don't give them any more employees. Next, our budget caves into the loudest voice and political muscle. It rewards those veteran sandbaggers who are experts at padding. Those are those managers who've been in the company for many years. They know how to play the game. Put more into that budget, so that just in case something goes wrong next year, they're not going to have an unfavorable budget variance. Incorporates last year's inefficiencies into this year's budget. Our current process is inefficient, but we just basically replicate it next year. But the one that bothers me the most is this last one. When managers are a few months away on a glide path from not spending all of the budget that was allotted to them for that year, what do they start doing? They start spending. They start spending needlessly, foolishly. Why? Because they know that the next year's budget is going to basically be pegged to how much they spent this year. It's because everybody does spreadsheet budgeting. This is probably how many of you do budgeting in your organization. Let me describe it. You give each of your line managers a Excel spreadsheet with their general ledger accounts, and they fill it out January to December, including as detailed as paper clips and rubber bands. Then someone in the accounting department consolidates all those cost center spreadsheets. They bring in the forecast of the sales. You give it to the executives. They say, well, that's pretty good, but there's not enough profit there. Go change some of the spreadsheets. So the managers basically start looking at their accounts and they lower some of the spending and the expenses. The accounting department consolidates it, gives it to the executives. They say, that's better, but not good enough. Up, down, up, down, up, down, up, down. You almost wish that the executives would tell you what number did you want in the first place. But that's not really what we want. We might want to know that as their aspiration, but we want to know reality. So this spreadsheet budgeting is not the way to go. It's incremental. Typically this way, you take the column B as the projection to the end of the year. We'll give them a 5% increase for inflation. So the formula for wages is column B times 1.05 and copy down. I hope some of you are laughing. Copy down. It's ridiculous. What if this department is going to have more volume next year? They're going to need more money or less workload. So how do we replace the budget with an alternative method that's basically a corporate performance management method? The way to do it is think about the amount of spending you will need in the future year as a result of 2 river streams. The upper river stream is the recurring repeatable expenses. It is demand driven, typically customer demand driven. The lower river stream is the non-repeatable, non-recurring expenses. and that will come from projects. And I'll give you a preview. There will be 3 types of projects. Capital projects, you're already familiar with. Strategy projects, those are ones that are needed to accomplish the strategic objectives of the executives. And then risk management projects. So let's drill into the upper river stream first. ABC is backward looking, but you can do a predictive view by calculating the costs in reverse. In other words, the traditional historical view, you start with your spending, you calculate the process cost to the outputs. But for the predictive view, you start at the bottom. You forecast the volume and mix, you multiply them backwards to solve for the level of capacity needed, number and type of employees, and spend with budgets. Remember the multi-stage cost assignment network? Well, notice all those arrows are going from top to bottom. But in your mind, reverse them so they're going from bottom to top. That's what's happening every minute, hour, day, week, month, year. The customers and the products are placing the demands load on the work activities. The work activities is drawing on the capacity spending, the costs measure the effect in the other direction. The point is, costing is modeling. It's not T accounts and journal entries. And so if we forecast the volume and mix, we calculate backwards. Here's why. For the historical view, the spending is known exactly to the currency of your country. We calculate the work activities cost objects, but we have a bonus. We pick up those unit level cost consumption rates, cost per type of order, cost per material move, cost per automobile loan. They will all have a unit cost. Then for the predictive view, we forecast the volume and mix, and we multiply backwards. Notice to the left, I call this Industrial Engineering 101. I think I learned this the second semester of my freshman year at Cornell University. Demand, volume, and mix times the unit level cost consumption rate equals the capacity required, number of type of employees, and of course their salary and wages, and the amount of spending with suppliers. Now, that's the upper river stream. Real quick, on the lower river stream, we've got 3 types of projects that I'm going to be a real fast primer on: the Kaplan and Norton strategy map and balance scorecard. They go together. You start with the strategy map. The balance scorecard, many of you have heard of, is basically a feedback mechanism. Of course, above that, something more important from the executives. It's the vision and mission statement. But it basically comes from the executives because they're telling you where they're setting direction. They're answering the question, where do we want to go? But what the strategy map balance scorecard answers is, how will we get there? What are the projects and the initiatives? And so real quickly, and you need to basically maybe go to Google and learn about strategy maps if you're not familiar with it. There are 5 components in a strategy map. They start with strategic objectives, and just briefly, the next step, ideally, is to have the managers and employees be communicated the strategy from the executives, and many are not, and have them identify the projects and initiatives to spend to achieve the strategy objectives. Now, the problem is, if you don't give them any money, 2 things will happen, and they're both bad. The executives are not going to implement successfully the strategy. That's their big frustration. And also, if the managers and employees have a bonus incentive system, they're not going to basically make their bonuses. So we want to fund those projects. Now we've connected strategy to the budget. Most companies, the strategy is disconnected. Next, enterprise risk management. The enterprise risk management community uses this popular grid. All of the circles inside are a potential risk event that will happen in the next year or more. The vertical axis is how severe the impact will be, how painful, how much money will be impacted. The horizontal axis is the probability that the event will occur. So in the upper right, all the blue shaded ones, we want to fund those to mitigate risk. Of course, you can't spend all your money mitigating risk. So let's go back to our upper or lower river stream. For the upper river stream, we use the calibrated unit level consumption rates. We use Industrial Engineering 101, forecast volume and mix, solve for the level of spending. For the project driven at the bottom, we do the capital budget. You're all familiar with that, so I'm not going to go through that. The strategy, project expenses, execute the strategy, the risk mitigation, boom. Now we have a much better number. And I'm going to decompose that diagram real quickly. The shaded boxes to the right, that's the upper river stream. The ones to the left are the lower. Put your eyes on the box that's at the bottom, derived budget and driver and rolling financial forecast. Notice what's coming into it. From the top is the operational budget, upper river stream. From the left, the lower, capital budget, strategy budget, risk budget. When we basically follow up to the operational budget, notice it really comes from driver consumption rates from the top, using management accounting, especially activity-based costing, and then the forecast volume. When we forecast volume and mix on the unit level rate, we get number of hours, number of pounds, number of kilograms, number of employees. Then we monetize it, euros, dollars, drachma, whatever your currency. That's a good number. From the left, I already described. So that is much better than those spreadsheets going up, down, up, down. But we will still have a similar problem, though, with budgeting. Notice, once we derive this reasonable budget, acceptable, yes or no, if the executives still don't like the number and we've got to lower it, the cost to improve the profit, what's the temptation? It could be, well, let's not do the risk mitigation spending. Let's not do the project spending for strategy. Bad. We do that, we don't execute the strategy, we expose ourselves to risk. There is one lever here to lower the cost. It's the unit level consumption rates. That's productivity improvement. That's where the lean management, process improvement, Six Sigma comes into play. Because if they can lower the productivity in the future months processes, 2%, 3%, 4%, then we basically will get to the budget profit level that the executives want. But forecasting is important. Don't treat forecasting as a special event. I love this cartoon. These three guys, they're saying, we haven't forecasted in a while. Maybe we should try that again. Forecasting should be an ongoing part of monitoring the business. And if any forecast is going to become less accurate one day, 1 week, 1 month after you do it. So in this graph, notice the vertical axis is the accuracy of the forecast. The time direction is the horizontal. Notice a day, week later, the forecast becomes less accurate. But if we keep reforecasting, let's say the sales volume and mix by the different products, service lines, stock keeping units, whatever it is, then we can go back to the previous diagram, and I'm not going to go there. And if you've got integrated ERP system and financial planning and analysis system, the only independent variable is the forecast. All the other ones are calibrated, or basically they're reasonably, if you will, submitted. So if we can now stop doing the annual budget and refresh quarterly, out 18 months, 24 months, we've now moved from budget to a rolling financial forecast. And now I'm going to tie this back. You're always saying, what about this new normal and the pandemic? Here's where it fits in. I can tell you in North America, board of directors are very, very concerned about the profitability, whether the board that they represent, that company is going to go bankrupt. They want to know net cash flow. So if you can do a rolling financial forecast out 18, 24 months, 36 months, and keep refreshing it, you will create a pro forma income statement and balance sheet. And those of you who are listening to me know what is the next step when you even have historical income statement and balance sheet, net cash flow. So now the board of directors can know, are we going to need to borrow money from a bank or issue more stock or debt because we have deficit cash flow? Or maybe we're in a business we're going to have surplus and we can then have to worry about or think about where we invested. That is the connection to COVID and the pandemic. And let me just say that the new normal is really to use many of these methods that I've been describing to you anyway. That's how to basically improve performance. It does get tricky, though, when we go to the predictive view. because the historical view to the left, that's pretty straightforward. You know, you get the spending, you assign them through the multi-stage cost assignment. You know, the spending's known, where did it go? We calculated. But the right side is trickier because you need to classify when you're doing predictive view next month, next quarter, next year, you need to classify the behavior of each resource as sunk, fixed, step fixed, or variable. And that classification depends on the planning horizon. Because in the very short term, 1 day, 1 week, it's very difficult to adjust capacity. You're not going to lay off employees on Monday and hire them back on Tuesday. But as the planning horizon goes out weeks, months, years, you might consider replacing full-time employees with temporary contractors. You might lease assets that you ordinarily would have purchased as a fixed asset. So you have to think like an engineer. Okay, let's start wrapping it up. I am looking at my clock. I'm going to end here, I think, in 5 minutes, and then we will have the discussion. If you're interested in knowing what stage of maturity is your company's management accounting system, I did also create a 30-page document for IFAC called the Costing Levels Continuum Maturity Model. And basically, I'll show it to you. I won't go in detail. You can basically go to my website or to IFAC and get the paper. It's pretty straightforward. There are 8 stages of the basically historical view, you know, the rear view mirror. I can tell you with empirical evidence, 95% of organizations are a 5D or lower. They're doing that standard costing, and then they're butter spreading the indirect expense overhead. 6D is the use of activity-based costing for product and service lines. 7D is going below the gross profit margin line. On the right side, there are 5 stages of the predictive view. Many of you are using 1P, spreadsheets where the managers fill it out, as opposed to moving up towards driver-based direction. So let me start summarizing. How does it all fit together? Corporate performance management. This is a diagram. Think of this like a circulatory flow system, like in your heart with your heart and your blood vessels. All of your assets, your employees are in the big box in the organization. I'll show you how this diagram flows in just a minute. But what we want to do is connect customers to shareholders. Remember, customers are the source of value creation to shareholders and owners. Now, where's management accounting and analytics in the diagram? I deliberately did not put it in there because the output of management accounting is the input to so many different places. In fact, in my activity-based costing executive guidebook in the appendix, I have 110 different types of decisions using management accounting. Okay, quickly, how does the diagram work? The executives will formulate the strategy typically based on the needs of the customers. Obviously, you could get more sophisticated and use the Michael Porter 5 forces model, but let's keep it simple. After the executives formulate the strategy, they will communicate it to managers and employee teams in a way they can understand it with the strategy map and then key performance indicators. And they'll put targets on the key performance indicators. Once managers get daily reports of the key performance indicators as feedback, they can answer our question, how am I doing on what is important? Imagine if every employee every day can answer, how am I doing on what's important? They'll look at the dial, favorable or unfavorable to the target of the KBI. And if every employee can answer that question, then it's how are we doing on what's important? Those 3 arrows, strategy management. Next arrow, targeting the customers. Remember what I went through, what type of customer is most profitable, most attractive to retain and win. Next comes the process view. You know, take the customer order, complete the order. That's where the lean management, Six Sigma, the process improvement stuff comes in. And so shareholder creation is not just a goal, it's a result of all of this stuff flowing. And I hope my Zoom is working for you. These bubbles are flowing through. These are happening every minute, hour, day, week, month, year. So to the degree that any of these veins may be constricted, then the money is not going to flow to the shareholders. It's going to leak to the sewer, inefficient processes, poor targeting of customers. So this is a vision for you to think, this is how I want my organization to basically have all these methods in place. In the next couple of years, don't wait 5 or 10 years. Rapid prototyping techniques work. To conclude, what's happening is there is a shift between the source of return on investment from tangible assets to intangible assets. That is, there is a shift from buying machines and trucks and computer hardware and software to an intangible asset like information. And the return on investment from information increases exponentially in this diagram as you go from data to information to knowledge to intelligence. The problem is many organizations are stuck in the first 2 red bubbles. All they have is raw data and standard reports. All they can answer is what happened. In some cases, the IT manager gives some of the managers some drill down software. Vendors like Click, Tableau, Microsoft Power BI, they can drill into a line item of invoice, but all they can answer is what happened. Corporate performance management and management accounting begins with the first model, blue bubble, descriptive modeling. Now we not only know what happened, we know why did it happen because we used causality principles. Then when we go to the predictive view, future coming at us, we can not only answer what happened, why did it happen, what can happen. We can do what if scenarios, different sensitivity and driver-based rolling financial forecast. And then at the top, we've got prescriptive analytics optimization of all the choices we could make. What is the best choice? I'll skip that. Finally, and I'll be done in 2 minutes, my big frustration. Why is this taking so long? Why is the adoption rate so long? What are the barriers? The first barrier is technical barriers. They are IT related. Dirty data, low quality data, because someone put in the input information, but the IT function has a tool called extraction, transform, and load, ETL. It'll purify the data. Also, some companies have diverse hardware. We've got IBM equipment, Dell equipment, Hewlett-Packard. IT can fix that. Next problem, the perception barrier of excess complexity and affordability. Many of you still think activity-based costing is way too complicated. I'm sorry, get out of that thinking. It can be done quickly. So you're blocked from moving ahead because you think it's too difficult. But the real barrier has nothing to do with software, systems, or methods. It has to do with people. It's organizational behavior barriers, involves resistance to change, culture, and leadership. That is resistance to change. People love the status quo. They do not want change. Only babies like change with their diapers. Other problems, fear of others knowing the truth. They don't want other departments to know what things truly cost. Fear of being measured, fear of being held accountable, weak leadership. There, I said it. The problem is it's a change management issue. You've got to learn how to get buy-in. So the complete vision of performance management, these gears are my analogy of all the methods, strategy map, profitability reporting, make the revolutions per minute of these corporate performance management and business analytics gear spin better, faster, cheaper. That's the productivity. Safer. That's basically using enterprise risk management, and smarter. So get educated, get buy-in. These are your action steps. And thank you for attending this webinar. You're getting educated now. Use these rapid prototyping methods. Start small, think big. Got to have some incentives. There's a couple of links there. And do not have to buy these books, but your success depends on how well and how fast the right information intelligence gets to the right people. Most of these books, chapter 1 is a free download. I know we went a minute or over, AN, but if you want to email me, there is my email address. Also, you're welcome to invite me in LinkedIn, and there's my website. So AN, I'll hand it over to you to facilitate the panel discussion.
Thanks a lot, Gary. That was really an awesome presentation. And that is definitely equal to what Gary is all about, I know, for the last 20 years. Fantastic, Gary. Thanks a lot for that very brilliant flow. And it came in a real, I would use the term which is very popular in this part of the world, a tsunami flow. That is
I call it an MBA in 90 minutes. An MBA, instead of going for a 2-year MBA, you got it in 90 minutes. Most of the stuff I talked about is in the curriculum of any MBA school, Stanford, Harvard, IIT. I'm familiar with your universities in India. We touched on profitability, strategy, change management. What did we leave out? But you got it in 90 minutes.
that only prompts me to say that we need to listen more and more to your wonderful wisdom. But one thing I would assure you, Gary, regarding the last slide, barriers, what you said, those barriers are global and universal. It's not only in the part of the globe where you reside. We also face such barriers in this part of the world. So now let's not waste time now. Once again, I thank you very much for that brilliant flow. I would now proceed straight to the panel discussion. And we have got a brilliant set of panelists who are with us today from Australia, from Sri Lanka, and from India. And in particular, we have from Sri Lanka the gentleman, Mr. Mahendra, who heads the Cost and Management Accounting Standards Board we have constituted in Sri Lanka. I would invite Mahendra to pose any issues which he thinks is very relevant in the context of Sri Lanka, picking from the presentation of Gary. Mahendra?
Yeah, thank you, Raman, and thank you, Gary. Very useful presentation. I hope you can hear me.
I can.
Yeah. In fact, yes, it was a very comprehensive presentation, and I was particularly interested in your how you blended the corporate performance management with all other relevant elements like lean accounting, lean management, Six Sigma, benchmarking, risk management, all those, because finally all these elements should move together and move swiftly for an organization to perform. As you quite rightly said, all wheels should synchronize and turn in unison so that the company can perform effectively. Actually, in Sri Lanka also, the concepts are no different and the challenges are no different. Actually, this COVID situation also has made the Sri Lankan companies face unexpected challenges, of course, I would say, because most of our companies were not really, actually, I think that the rule was not basically, lean accounting, lean management, Six Sigma. Actually, a lot of companies don't follow these things. A lot of companies don't try to implement these. But now we have seen, actually in the recent past, we have seen a lot of companies trying to, migrate to implementing these processes and techniques, because they increasingly find that if they don't, their competitors will do, and finally the companies that don't do these things will fade away. Because okay, doing this is not will not guarantee success, but not doing it will guarantee failure, because everybody else will start doing it. So actually in Sri Lanka, if you look at performance management, especially from a costing point of view, actually I must say, Gary, Sri Lanka is one of the best countries for commerce education, right? Because our young our youth, who are following commerce studies, they have fantastic opportunities in Sri Lanka to follow all the programs that are offered in the world, like CIMA, like CMA, like CPA, like Chartered Accountants, like CFA, all these. So actually our accounting professionals are very knowledgeable, well versed with most of these concepts. But I think as you quite rightly pointed out, sometimes they find it difficult to connect all these concepts. That is why this budgeting, you know, in the usual way, you ask whether we should budget at all. You know, I mean, you know, taking past experience for budgeting, taking past data for budgeting, actually not asking the critical question whether all these expenses are really necessary. Are they adding value to the organization? Every expense should add value to the organization. And you know, our accountants should learn to investigate any cost that doesn't add value to the organization and take steps to eliminate those costs. So actually, from, you know, to sum up, it was a very useful thing. So actually, Sri Lankan situation is no different. We have a lot of challenges, and of course, I think we are I mean, we are becoming more and more aware as to what need to be done. But actually, from COVID situation, particularly, Gary, more than the costing and accounting challenges, we have real challenges coming from supply chain management and in this Corona situation. The countries are country lockdowns, and then supply is getting interrupted, and ports are becoming very, I would say, inactive to a certain extent. You know, we finding it difficult to getting raw materials, trying to export goods. You know, so I mean, actually, multiple challenges, and that way, I think our professionals have their brains working overtime right now to try and address these issues. And actually, I don't have a question for you, but my comment is that yes, we need to look at all these. We need to understand that all these concepts should be properly linked, synchronized for a company to perform. And this COVID situation is making this process more and more timely, and we require that if we don't do this, the companies will just disappear. That is my comment, really.
Just a couple of comments. I did co-author a book called The Handbook of Supply Chain Costing for the Council of Supply Chain Management Professionals. I will email to you. It's a 30-page summary of the book, because supply chain costing needs to be inter-organizational. You need to know basically the profit and loss upstream and downstream of the trading partners, not just within your four walls. Regarding your students being really highly educated, that's wonderful. I love motivating students, but the challenge there is most organizations over-plan and under-execute.
Sure.
What I mean is, having the learning is one thing, but the real power is in the doing. And so, you know, nothing happens unless you take actions. And that's where this problem of the perception barrier, like, well, we don't want to go ahead because it's going to be too complex. We've got to use these pilots, prototypes. You know, my personality is 80-20 Pareto's law, you know, ready, fire, aim, you know, bias towards action, go fast, fast, fast. It doesn't have to be perfect. I do want to make another observation. I don't know whether Sri Lanka has a similar problem as in India, and probably several people who are listening, I think, are from India, but this is a concern I have. India has way too much emphasis on external financial reporting for statutory and regulatory reporting. And because of that emphasis, there is an imbalance. So the accounting department is spending way too much time closing the books and worrying about getting everything absolutely correct when they give the information to the government and the regulatory agencies and the investment community. So as a result, there's not enough time to do the management accounting. They've got to basically get that balance back, spend more time, close your books.
Same situation, Gary, here. Same situation in Sri Lanka. We are no different from India that way. We spend far too much time on you know, meeting external reporting requirements, and we don't spend enough time planning our day-to-day executions in order to improve performance? I'm talking about finance professionals.
Yes.
Gary,
Hold on.
can you kindly close your screen? Is it possible to close the screen? Then we can
Me?
come on. Yeah.
Oh, yeah. Okay. I guess, I can do the stop share.
Now, Gary, I think you should permit me to move over to the next panelist, Professor Nuwan Gunaratna, who knows a lot about the Sri Lankan management accounting education. And I also congratulate him on his new venture in Australia, securing the PhD. May I now request Professor Nuwan to select his pattern of questions, whatever you would like to highlight to Gary.
Thank you, Mr. Raman. First, I'm not a professor.
You can put on.
And thank you very much. Yeah, thank you very much, Gary, for your interesting presentation. Actually, I had the feeling that I was a student and listening to an interesting presentation on activity-based costing and performance management. So my question is this: now, as you explained, moving into ABC is not actually a challenge as we think. So within, as you said, within few days, with few executives, you can get together and have some changes into your costing system. But as you rightfully explained, companies are having these barriers that actually prevents them from moving into ABC. So what do the companies really need to do to move their costing systems to better align with the ABC? What are the few simple things that accountants or the finance professionals can take to have their costing systems better aligned with ABC?
It all involves behavioral change management. This has got nothing to do with methods, software, systems, although there is commercial ABC software. You have to get buy-in from others. And I'm not a psychologist, but I don't think any of the people listening here have degrees in sociology or psychology and behavioral change management. Most everybody listening to me, including you and me, we are what I call Newtonian managers, like Isaac Newton. To us, the world is a big machine. Give me the levers, pulleys, dials, ropes. We need to be a bit like Darwinian, like Charles Darwin, the organization sense and respond. So where I'm going with this is a technique that I believe change management people use. Involves a formula, and you may want to write this down. It's called D times V times F is greater than R. D as in dog, V as in victory, F as in freedom is greater than R, and R stands for resistance. So resistance is a large number. Do not underestimate how much resistance to change people have. So now you're asking, well, what does D, V, and F stand for? D stands for discomfort with the current state. And incidentally, notice with D times V times F, they're multiplicative. So if any of them are very small or zero, the left side will not overcome the resistance. So we need D, V, and F in abundance. So D stands for discomfort with the current state. Unless people have discomfort, they don't care. If they are uncomfortable, they're looking for the lifeline. They're looking for the lifeboat. That's where V comes in. V is a vision of what better looks like. So V is all of these seamless methods, the CPM method, strategy, budgeting, profitability reporting. Now you would think if I've got big discomfort and I've got the solution, D and V, I'm home free, will overcome the change. F is the sleeper. F is first practical steps. Because if they think your solution is impractical, overly theoretical, unaffordable, too complicated, they're not going to go ahead. So in the context of this presentation, the F is the rapid prototyping, build the models quickly. Now let me directly answer your question. The way to get to D is through what I call the Socratic Method. You may be familiar with the Greek philosopher Socrates. I'm actually Greek American, incidentally. My parents are from Athens and Kalamata, if you're familiar with the Black Olive. Anyway, you ask pain questions. Does everybody understand the strategy? Are we measuring the right things? Do we truly know which products and services are more or less profitable? Do we know which types of customers are more or less profitable? Is our budgeting system really working for us? Notice I just gave you 5 questions. You could do 15 of them. If you're doing those questions with an executive, what are you doing? You're making them feel uncomfortable. We call it fear, uncertainty, and doubt, FUD. And once you can create that discomfort without jeopardizing your job, you don't want to like make them so mad, get this guy out of here. You're opening their eyes to want to know, well, you're right. We don't know. We're not measuring the right things. We don't really know our problem. How would we do that? Now you bring in the CPM methods. So that's how you overcome the barriers.
Thank you, Gary. May I now request Thiru to post any issues you think we can pick the brain of Gary.
Thank you, Gary. It was an outstanding presentation. The sheer integration of all the concepts was amazing. And as you rightly said, in 60 minutes, we probably learned more than what you would do in MBA for 2 years. I have two simple points. One is the information technology services industry, which is very large, is substantially focused on people costs, the technology, the hardware, the technology cost, and workspace cost. How would you look at corporate performance management for an IT services kind of business?
Okay, I think, here in background, it may be Tyrell Roche. That may be you. Put yours on mute. Yeah. One thing, there wasn't enough time. There is what's called the IT chargeback system, which is internal. This is back within a company. You can actually take the information department and actually trace and assign their costs. They're like an internal invoice charges to the user departments. That can be quite helpful because, if the user departments don't get that report, then the services are free. And anytime anything's free, what do? You abuse it, you use it. It's free, So that's a way to, it's called the chargeback system. It's like an internal invoice. I'm not sure I'm totally answering your question, but there needs to be visibility of the IT department. So the IT department is like a business. They have to basically be selling their services to the users within the company.
Yeah.
Were you talking about internal IT or something?
No, I was talking about service industry as a business, which is very large in India and other states. So how would you apply? Yeah.
I've been to Infosys, Wipro, I've been to Bangalore. I spent a week there going on. They're in the same situation. I mean, you can still use managerial accounting to calculate the cost of outputs, and or maybe a little more project accounting. The point is they need the Infosys. I'm just using them as an example, although they're a consulting firm as well, but they need visibility. And if their accounting department is not providing visibility to the line managers, then, how are they making good decisions? I have a phrase, in the land of the blind, the one-eyed man is king. In the land of the blind, the one-eyed man is king. When you have visibility, you're going to outsmart your competitors.
Thank you.
So Gary, I would like to put a question to you on behalf of Sri Lankan industry. And many of the Sri Lankan export-based companies are in a business model where the prices are fixed by the foreign buyers. The raw materials are dictated by the foreign buyers. The technology is chosen by them. And everything almost is done by them, and only a manufacturing, let's say, or conversion takes place in Sri Lanka. Let's say in that sort of ecosystem, do you think advanced management accounting tools like this can deliver value to them?
Well, I did not know what you just described. And as you were describing it, I said, wow, they're stuck in a box. Meaning if your pricing is basically dictated to you and your purchase costs are dictated to you, you don't have much left than increase efficiency. And, there's a limit. You can't, my belief would be, and this is, get enough of the facts that are valid and defendable, and then go negotiate. in the supply chain. Go to your supplier and basically say, we're not going to be profitable. We may be bankrupt unless you can reduce your price to me. And then on the other side of the supply chain trading partner, go to your customer and basically say, you know, I think we've been a good supplier to you all these years, but we're really in a box here and we're going to go bankrupt. Show us some heart. Can we increase our prices to you? So what you basically described is it's fixed on the pricing side, it's fixed and, you know, go negotiate, but you be much more, have a stronger business case if you can bring the numbers in and show them this is where we are. It's called, you know, transparency. We're going to open the kimono. We're going to show you our income statement and balance sheet. That would be a way, be negotiating higher selling prices and then lower purchase prices.
But Gary, would you not think that in these situations, target pricing and target costing would be a really a good option for that sort of business models in Sri Lankan industries?
There's a lot of semantics problem. Target costing is target costing is only on new product development. So, you know, it's easy to just use the word target costing, but the true purpose of target costing is when a product is newly being developed, you really actually go figure out initially what is the optimal selling price to the market. And you don't do cost plus. You don't say, okay, you know, the old way is let's just see what it makes to make a new product. We'll mark it up 10%, put a price on it. You start with the pricing and then you basically put pressure as the product is being designed, you know, replace gold with copper, you know, replace diamonds with, you know, so target costing is only used on new product development. So that's a semantics issue.
Raman, there are some questions on Q&A. I don't know whether...
I saw those questions, Lakshman, but they are in the context of India and little bit more academics. I would like to put Sri Lankan issues first and then try to elicit response of Gary. So I request now, Ruchira, would you like to pose any points to the professor?
Yeah, Mr. Raman. Gary, this question is about balance scorecard. Now, recently we have seen some of the multinational organizations such as Tesco, they have moved away from the corporate steering wheel. I mean, they had about 40 KPIs under the balance scorecard. Now they have only 6 KPIs. So what do you think? What do you think is the correct way to go ahead with the balance scorecard? Should we have the same number of KPIs, maybe 30, 40 KPIs? Or like Tesco has done, should we reduce the KPIs to about 5 or 6?
Well, since I was a consultant for many years, I learned that there's only one answer to every question, and that answer is, it depends. I'm being a little humorous. Let me just say this. Usually the problem is that people have 400 KPIs or 600 KPIs, and because they measure anything that moves. And my message is always, oh, good, you've got 400 KPIs. How can they all be a K? So this comes to a definite, and it's okay to measure 400 things. It's just that there's what are called key performance indicators and then operational performance indicators. You cascade them down. The definition of a KPI should be this: monitoring the progress towards accomplishing strategic objectives. I'm going to repeat that: monitoring the progress towards accomplishing strategic objectives. And a typical Kaplan and Norton strategy map, this is a primer, if others don't know about this, go Google it, has 4 perspectives that has cause and effect. Learning and growth and innovation, contributes to the process improvement objectives, contributes to the customer profitability, retention objectives, contributes to the financial. And typically there should be 2 to 3 strategic objectives in each perspective. So if we take 3 times 4 perspectives, that's 12 strategic objectives. Now I'll go take it further. I believe that one should have 2 to 3 KPIs for each strategic objectives. Because remember, this is being cascaded down to different departments. They're all being held accountable. so that they can play like an orchestra, you know, strings, drums, brass. We want the whole thing to play together like Beethoven. So if we take 12 strategic objectives with 3 KPIs, that's 36. So I would challenge Tesco going to 6. You so oversimplified it that how can employees and managers have line of sight to how what I am doing today and this afternoon and tomorrow? I'm trying to move these needles. I can't have line of sight about what I'm doing. How does it affect that? But if you've got 36 KPIs, meaning 3 KPIs for each strategic objectives, 3 objectives for 4, and I'm distributing that amongst all my managers, I really now have an orchestra. And they're going to all play together. And what we're doing is we're aligning their behavior and their decisions and their actions and their priorities with the strategy, because it's about strategy execution. So I can send you, I do have an article that discusses this. I'm going to send it to the team later today. And if they want to distribute it, it differentiates KPIs from operational PIs.
Thank you, Gary.
So, Professor, can we take one question from the box which has come in the Q&A box?
Yeah, most certainly. Yeah.
Yeah, one question, Gary, which I'm sure you would enjoy answering. When you take the customer cost for matching with the revenue, how do you consider the cost which can flow to a company on account of guarantee given to a customer over a life cycle of a product? How do you bring that in and not depending on the accounting booking of the cost?
Wait, I didn't understand that. The price is fixed? What?
No. When you match the cost incurred for a customer with reference to the price obtained, either on an individual basis or a customer segment, either way, how would you bring in the life cycle costs of customers when the products are being used beyond a year, and there are certain life cycle costs which the company is incurring because of the guarantee given for the product? How would you reckon those costs in cost of serving the customer segment?
I am not sure I'm understanding that. You know, maybe you don't want to put overemphasis on management accounting. I mean, what I was describing is you can calculate the reasonably accurate, notice I word reasonably accurate, 95% cost month after month after month, you know, but cost information does not provide you answers. Cost information provides you questions. Because once you see stuff that you hadn't seen before, or it's very different than what you believed, it's like, what? Why? So I don't think I'm answering this particular person's question, but I'm just saying,
Gary,
at least...
Gary, let me intervene here. The question is, how do you bring in the life cycle cost of a product when you look at the cost to serve to the customer, and your products have got a more than 3 years or 4 years life cycle? How would you bring in the life cycle cost of your products when the customer uses it? That is the basic point.
Well, but when you say like once the product has been released and is through, you know, it's in existence, maybe there's some efficiencies to it. The product cost isn't going to change. But now there is what's called life cycle costing, when you take it all the way to abandonment, and, you know, new versions of the product are now replacing old versions, maybe that kind of stuff. It's almost like a capital budgeting problem.
Okay. He was looking at guarantee cost, what a company incurs by giving guarantee to the customer on account of the product usage. How would you reckon that over a life cycle of a product was his point?
I guess I'm not this guaranteed. I mean, if that was negotiated, then you've got a constraint. Then it just takes one lever away. You can't, all you can do is be more efficient making the product.
And a couple of observations complementing Guarantee's presentation in the Q&A, and Mr. Gopalakrishnan, past president, expressing from our institute in India, expressing his appreciation that it was really a futuristic, fantastic presentation, great learning. Couple of them are very good feedback and observations complimenting Gary. That's it.
Okay.
Lakshman,
Well, we only have 5 minutes left. I want to just mention something because to me it's a professional courtesy to end on time. So let's not take people longer than what they were scheduled for. I want to say something briefly, and then you can do concluding remarks. And then I think in the past, the best leaders and best executives had the best answers. Today, I do not think that's the case. Today, I think the best leaders and best executives have the best questions. There's too much complexity. There's too much volatility. There's too much uncertainty for them to rely on their gut feel or intuition or so-called sixth sense or the types of answers they had earlier in their career that got them promoted to be the top. They need to create a culture for investigation and discovery. This is where analytics and management accounting comes into play, and tolerance for making mistakes. It's okay to make mistakes as long as you learn from mistakes. So I just want to say, I'm looking for leaders that don't say, oh, I've got the answer. I'm looking for leaders who basically, I will ask questions and bring people on board. So that's my final remarks. You can do closing remarks, and it's just a privilege to present. And I hope people can feel free to email me and I can answer questions that way.
That's a fantastic sum up, Gary, because all these tools which you have very nicely presented would really make the executives ask the right questions. And that's a brilliant summing up you have done. I thank Gary, and let me hand over this session back to Professor Lakshman. He said he would like to invite Komal Chitrakar, past president of SAPO also. He would do the rest. Thank you, Lakshman.
Yeah, thank you very much. Yeah, before I close, Komal, you want to say anything, or because I think we have just two words, not very long.
I just would like to thank you, Lakshman, and also very pleased to meet virtually our old friend Raman, with whom I worked closely during my presidency in SAFA, and it has been a wonderful experience attending this program, which is very surprisingly new things I have learned. And if you could share these slides and more materials, I can spread it around in Nepal also. Thank you very much, and I look forward to more opportunities in attending this sort of learned programs. Thank you very much.
Thank you, Mr. Komal. Thank you. Can everyone open their screens, because we need to take some photographs in the final stages. So let me thank Gary. I think it was really a very, very excellent presentation on the, you can please mute yourself, but open the screen. Please mute, but open. Thiru, if you can also open, that will be good, the screen. So let me thank you, because it was a very, very excellent presentation, especially speaking on the cost management to drive business performance. In an atmosphere where we are really in a new normal situation. That's the most important thing, because I know that today cost performance, the cost management has become extremely important. So I think you really drove the necessary points for our participants. There were quite many who had many questions. I saw one even from the Apollo Hospital, one of them asking how ABC is going to be activated for when there are different types of patients, you know. So I think those are things that most probably by email he can contact you and get a sort of answer. But this is of great importance, and I must also thank Nuan, who's now got his doctorate, for the keenness that he had shown in getting Gary. Gary, this is not the last time that you're going to be with us. I think it's now going to be a continuous relationship with CMA, like either Mr. Raman or Thiru or any of our foreign guests who are here. Komal is also there. So I think we need to develop, as I said earlier, cost and management accounting is still new in Sri Lanka. So we need much more sort of maybe practices, and also the method by which this could be implemented to give the benefit not only to the industry, but I think mainly to the services sector. And I think it has to come into the government sector. Today, we are quite strong on the integrated reporting, where we are looking at the value creation. So we really now have to look at how the cost management will be able to create value. I think that's a good thing. Maybe sometime later where we can invite you to speak on that, on the cost management area, because we just had our budget is still on. They are all maybe allocating lots of money, but we don't know what is the real output going to be, because there should be a final report telling these are the values that have been created by each and everyone. So cost management has become extremely important. The debt management is another area which has really gone into. I think economists have taken the lead in that, but we need now the cost and management accountants also to tell as to how these could be managed and done well. So let me thank Gary, then also Mr. Raman, who's always been with us. I'm happy that I've been able to get you together, because he's been able to maybe really know the strong areas in which you are doing, and also to prompt you with other areas where you could maybe really speak to us in this respect. And the other area now, Mr. Mahendra is there. He's the chairman of the Cost and Management Accounting Standards Board. Now that's another area where we need a lot of support. So I'm sure that he also would also got new ideas as to how we can implement the cost and management accounting standards. And of course, Dr. Nuan is doing quite a lot of work on the environmental area. He's also doing a lot of research work in that area, and I think that he will also help us a great deal. Then of course, Dr. Thiru, thank you very much for being present, and all the others. Our Vice President is also here. I don't know whether our Gary has been knocked off, or I don't know whether he's gone off, but certainly let me conclude this session. Thank everyone for their presence, and also all our participants who's been there maybe for a long period of time. But in this new situation, I think we are gaining ground. We are also connecting up internationally, which is extremely good. So thanks very much, and good night to all of you.